Believe it or not, you can make money when the market goes down. Here's how. What's going on, traders? Today's topic, shorting. Shorting, going short, selling short. What does that even mean, right? Well, I'm here to explain it to you. So, you come into the morning and you get to your desk and you start going over your watch list. You're looking at the gappers, right? Looking at the percent moves. And you see some stocks you're interested in. They've moved a lot so far in the pre-market. And you're thinking, hey, I think I might want to go short up here. I want to sell short. I think the stock might go down, so maybe I can make a profit by selling shares I don't have. What? Right. Here, let me explain, okay? So your broker, whoever you're trading with, whether that's TD Ameritrade, Schwab, TradeStation, CMEG, Lightspeed, whoever it happens to be, right? Your broker is going to have an inventory of stock that they will allow you to borrow and sell without actually owning it. Okay, so let me explain a little deeper here. So your broker is going to have shares of stock that you can borrow and sell to another trader or investor without actually owning those shares. This is called borrowing. Okay, stocks will be marked with an ETB indication to let you know if it's available to borrow that day. Every day it's different. It's actually different from hour to hour. So sometimes they might run out of stock to borrow in the first hour, and you won't be able to, or you got to pay for a locate. But that's a whole nother topic. Let's continue here. So when you borrow a stock, from your broker to sell, and you don't own it, the broker is going to want that stock back, obviously. Okay. Holding this position and not giving the stock back by the end of the day, when you start carrying the shorts overnight, not only are you facing extreme risk with gapping, shorting carries a lot of risk. So this is a very disciplined. You have to be very mentally disciplined for this. This is not for a new trader to do. You don't want to short when you're just learning what's going on. But me personally, this is how I make my money every day. This is why when you see charts next to my, social medias or anything, they're typically going down, like hard down. And to the untrained, uneducated viewer, they're probably thinking like, bro, it went down, dude. Why are you showing us you losing money? Well, I actually didn't lose money. This is like my bread and butter. This is my thing, okay? Shorting is my deal. So let me explain to you how it works from a high level view so you kind of understand how you can even profit from the market going down, all right? So step one, we come in, we see a stock really high up, and we think, hey, I think it's going to go down, right? Well, there's going to be other traders out there in the world that are going to be thinking that it's just going to the moon, right? This thing's going to the moon. I better get in right now. I can't be waiting. What if this goes to $1,000 in 10 minutes? I got to buy right this second, right? Well, that's the guy I'm trying to sell to, right? And because I don't have shares of the company, I'm going to go ahead and borrow from my broker 100 shares, to sell. Now, I'm going to take those shares and I'm going to sell them to that guy. Let's call him the FOMO buyer. And I don't know exactly who it's being sold to. I'm just generalizing here because at the point where I do sell short, there's usually a lot of volume happening from people who are afraid that it is going to continue, and I step in to make a bet on the opposite direction. So these are the people that end up buying. All right. So, like I said, after we borrow, your broker's going to want these shares back. The longer you take, if it's longer than a day, I believe the overnight fees, at least at my broker, are like 2 to 3% the total value of the position. So say the position is like $10,000. they're going to want $200 or $300 every night that you hold this. So if you hold it for 10 nights, they want like $3,000, and it'll just eat into your chunks of your profit here. So I don't mess with that. I close out very soon after I short. I don't even do overnight trades at all. Okay. Just to give you an idea of my style. Okay. So now that we took our shares and we sold them to the market, okay, to our FOMO buyer who thinks the market's going up, 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 up. It's going to the moon, baby. I'm now going to be negative, right? We are now negative 100 shares in the hole to our broker. This is what we have to pay back, 100 shares. Now, when we sold those shares to that guy, right? Let's say we sold our 100 shares. 100 shares sold at $10 a share. Okay. So that is a $1,000 value. Right. So I just borrowed $1,000 worth of a stock and then sold it off. Right. Now I owe that 100 shares back to my broker. So what am I going to do? I'm going to wait. I'm going to let my charts play out. I'm going to let my, my strategy play out. And when my strategy says it's time to get out and exit this position, in order to exit a short position, you have to buy. Okay. A long position, when you're buying, hoping the stock goes up, in order to get out of that, you need to sell. Well, this is now opposite. Okay. So we sold first, and now we have to buy to give back the shares we borrowed. All right. So we sell John Doe here shares, putting us short the stock, right? The price falls from 10 level that we decided to sell the shares at. Let's say the price is now at $8, right? And our trading system says, hey, you know what? We found some buyers down here. We're getting a strong change in market direction where we might be heading back up, maybe even just to equilibrium, but $2 is a pretty good move. So let's say stock went down. Right? It went down $2. So now we're at 8, right? So now I am going to have to pull 100 shares from the market by buying them, right? So I'm going to buy my 100 shares at $8, okay? And this is $800 that it cost me to get those 100 shares back, all right? Some of you might have just realized where I'm going with this. Now, because there was a $2 difference per share, all we have to do is return the 100 shares back to the broker. We initially borrowed $1,000 worth of stock for 100 shares, and now we need to return the shares. And this is only going to cost us $800 to purchase, okay? So when we send those back and it closes out our position, right? We send the 100 shares back. Nobody really cares what the prices were, all right? But we do. And the difference here is going to be a $200 difference, right? From 800 to 1,000. Now, this $200 doesn't just disappear. This is the profit you just made on this trade by going short and the price falling from $10 to $8, right? So I hope that answers some of you guys' questions. I know that shorting seems really intimidating, and it kind of is. It is. It took me a long time to get comfortable with it, but, psychologically, mentally, emotionally, this is my bread and butter. This is what I do. This is how I make money, and 90% of the time it's shorting the market, and that is how shorting works. So just one little side note here. Let me, what do I want to say? So the one little side note is shorting is risky. Okay. Shorting is risky. And why is it risky? Well, when you buy a stock, okay, that's kind of risky too, but the stock can only go down 100%. So say you bought a stock at $10 like we were talking. And I'm clearing off my paper here so I can write on it again. Okay. So say you bought the stock at $10 and you bought 100 shares. Okay. All right. So that's going to be your risk here. If you're holding all the way to zero, if you're just going to put your hands up and say, whatever happens, happens, we'll see what goes on. And the stock goes from $10 down to zero. All right. You lost $1,000. Okay. And that's a minus 100% move. This is extremely rare if it ever happens. Some of them, I think, get really close to zero, but I don't know if I've actually seen a stock go to zero. So here's the next thing. Okay, so this is when you long it. This is buying in hopes of it going up. Say you're wrong, it comes back down. It goes all the way down to zero. You can only lose $1,000. Okay, well, check this out. If you go short, all right. And let's say we go short, I don't know, 100 shares, just like we went long, at $10, okay? Your maximum percent move is not $100 in risk, because up is our risk. When the stock goes up and you're short, you lose money, all right? And over here, if you buy the stock and it goes down, you lose money, but you can only go down 100%. Now, how far can you go up? Okay. So from $10 to $20 is 100%. From $10 to $30 is 200%. From $10 to $100 is 1,000%. So let's just say that it went to $100. Okay. It went up to $100. Our initial $1,000 bet here just got smacked by 1,000%. So that means what? We lose 10 grand, right? So our $1,000 short, okay, carries let's say the stock went from 10 to 100, right? We are now negative $10,000. And this is with working only with $1,000. Okay. So when up here on the long side, the $1,000 can go to zero and you lost $1,000. But if the stock goes from $10 to $100, you just lost $10,000. Okay. And it can keep going. It doesn't have to stop at 100. Your risk on a short is essentially infinite, right? This stock price, the one that starts at $10, it can go to what? 3 grand? It can go to, let's say this stock is like Amazon, brand new. IPOs at $10, you're like, I'm short. And that thing ran to $3,000. You are absolutely screwed. You'd be down like what, 300,000 or something like that. That's a house, right? So just understand shorting is risky. It's much more risky than going long. That doesn't mean you shouldn't do it. That just means that you have to be present in your trade. This is not something you set and walk away from. This is not something that you take lightly, okay? Percents are important. And for a stock to go down, it can only go down 100%. When the stock goes up, it can go up infinite percent. And every percent it goes up when you're short, you're losing money. All right, so that's my little warning. Just pay attention, okay? All right, so I hope I answered some of you guys' questions on that. How does it work? That's how it works. You borrow shares, you sell it to the market, you buy the shares back, you replace what you borrowed, you get to keep the difference, right? And then my little risk worry here, if you go long on an item, you can only lose 100% of your investment, but if you go short on an item, you can theoretically lose infinite percent on that investment. So shorting is much more risky. But if you want to do this as a job, if you want this to be your career, then you have to be able to go both directions, long and short. As you see, the whole first 6-7 months of this year have been down, 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 down. What are you going to do? Not make any money? No, you got bills to pay, bro. Right? So you got to learn what the market offers and what you can do. And this is a tool that's given to you by your broker, and the market allows it. And there's a lot of other things to it too. It keeps the market efficient, this situation, short selling. It's not evil. It's not un-American. It's not betting against America. All right. It's a way of trading, right? It's nice being a trader. It doesn't matter if the stock goes up or down. You could still make money. That's a nice feeling, right? All right. Well, hope you guys have a good rest of the day. I hope that answers some of you guys' questions. I know I got a little long-winded there at the end, but like I said, this is kind of my thing. And I'm trying to make this video quick, and I'd say I didn't exactly succeed at that, but if you made it this far, please hit the thumbs up, subscribe, comment on the next topic you'd like. Have a great day. Bye.